Britain isn't broke by accident, it's been engineered into debt. From rising rents to silent subscription fees, millions are working harder yet feeling poorer every year. The shocking truth, it's not just about how much you earn, but how the system drains what you keep. Every pound you spend, borrow, or delay paying back feeds an economy designed to keep you chasing stability that never arrives. While politicians talk recovery, ordinary people are drowning in invisible costs they're never agreed to. These are the 10 hidden money traps quietly keeping the UK poor, and most people don't even see them coming.
Number 1. Skyrocketing household debt. Across the UK, household debt has reached record highs, silently eroding financial stability. Recent data from the Bank of England shows that the average household now carries over £65,000 in combined debt, including mortgages, credit cards, and personal loans. What makes this trap so dangerous is how normalized it has become. Families rely on credit to maintain a standard of living that their income no longer supports. Rising prices, stagnating wages, and easy access to short-term loans create a vicious cycle where people spend tomorrow's money to survive today, keeping them perpetually behind. The problem deepens when interest rates rise, amplifying monthly repayments and shrinking disposable income. Credit card balances in particular have soared by nearly 13% year-on-year, with many paying only the minimum amount each month. This illusion of manageable debt hides a growing burden that compounds silently over time. Lenders benefit, but consumers face reduced borrowing power and limited financial mobility. The pressure of debt also spills into mental health, with a growing number of Britons reporting anxiety over personal finances. Avoiding this trap requires a clear-eyed approach to spending and repayment. Building a budget that prioritizes essentials, cutting non-critical expenses, and focusing on debt with the highest interest first can make a measurable difference. Using tools like open banking apps helps visualize where money leaks occur. More importantly, individuals must shift their mindset from survival credit to sustainable living. The path to financial freedom starts not with earning more, but by controlling how each pound is used before it's borrowed, not after.
Number 2. Rising cost of living and negative budgets. The UK cost of living crisis has transformed ordinary households into financial pressure cookers. Recent reports from the Office for National Statistics, ONS, reveal that over 1 in 3 Britons, 1/3, now spend more than they earn each month, creating what economists call a negative budget. This means that even when paychecks arrive, they are already spoken for, covering rent, food, fuel, and energy bills that have outpaced wages. The value of money has fallen sharply, and middle-income families, once considered comfortable, are now forced to choose between heating and eating. This invisible trap tightens because inflation doesn't just raise prices, it resets expectations. When groceries rise by over 25% in 2 years, and childcare or transport costs keep climbing, every pound stretches less. For many, the quick fix is credit cards, overdrafts, or buy now, pay later schemes that disguise debt as flexibility. Over time, these small gaps accumulate into persistent financial holes. Economists warn that without structural income growth, many households risk long-term instability, especially as savings rates fall and emergency funds vanish. To fight this trap, individuals must treat budgeting as a living document, not a one-time task. Review spending weekly, track categories like food and energy, and cap non-essentials using digital tools or envelope systems. Explore community support, energy-saving grants, council tax reliefs, or local food initiatives to stretch limited resources. Building awareness of real income versus real expenditure helps regain control. When every expense is visible, priorities shift naturally towards stability over status, freeing households from a lifestyle that silently bleed them dry.
Number 3. High cost of housing and private renting. The UK housing market has become one of the biggest wealth dividers of this generation. According to data from Zoopla and the ONS, the average rent in Britain surged past £1,300 per month in 2025, the highest on record. For millions of renters, more than 40% of their income now goes straight to landlords, leaving little for savings, emergencies, or debt repayment. The illusion of flexibility in renting hides a harsh reality. Tenants are funding others' assets while owning nothing themselves. Property prices have climbed beyond reach for many first-time buyers, creating a nation dependent on unstable private leases. This trap deepens with stagnant wage growth and rising mortgage rates that limit new ownership. The dream of home ownership, once a British cornerstone, is now a luxury reserved for higher income owners or those with family inheritance. Many renters face annual increases, hidden maintenance fees, and short-term contracts that add emotional strain alongside financial stress. The government's housing reforms and rent caps have provided little relief, as demand far exceeds supply. Homelessness applications and overcrowded flats reflect how broken the system has become for average earners. Breaking free from this trap means adopting a strategic mindset toward housing rather than emotional decisions. Sharing accommodations, negotiating longer leases for price stability, or relocating to lower demand areas can reduce financial pressure. Using government-backed shared ownership or first home schemes may also provide entry points for ownership. Above all, the goal is not to chase expensive city living, but to design a housing plan that matches real income. Stability, not status, should define where and how one lives in today's fragile UK housing economy.
Number 4. Unchecked buy now, pay later and short-term credit. The growing popularity of buy now, pay later services has reshaped spending habits across the UK, but beneath the convenience lies a financial time bomb. What started as a flexible way to spread payments has quietly become one of the fastest-growing forms of consumer debt. According to the Financial Conduct Authority, nearly 4 in 10 users miss at least one repayment, triggering late fees and credit score damage. The danger is subtle. These services don't always show up on credit reports, creating a false sense of safety while debt quietly accumulates across multiple platforms. This trap thrives on psychology. Splitting payments makes expensive items seem affordable, blurring the line between want and need. For many young adults, it feels harmless until multiple repayments overlap and payday arrives already committed. With the cost of living crisis squeezing budgets, buy now, pay later fills the gap left by traditional credit, but at a steep cost. Companies use slick marketing to encourage impulse buying, while regulatory oversight still lags behind. The FCA's 2025 update warned that unregulated short-term credit could become the next payday loan scandal if left unchecked. Escaping this cycle begins with transparency and discipline. Treat buy now, pay later like a loan, not a discount. Use one provider at a time, track repayment dates in digital calendars, and only use deferred payment for essentials, never luxuries. If a purchase cannot be made comfortably up front, it likely cannot be afforded at all. The path to financial stability demands awareness over convenience, understanding that delayed payment is not freedom, but a silent form of debt disguised as flexibility.
Number 5. Inadequate savings and emergency buffer. A growing number of UK households are living without any financial safety net, leaving them dangerously exposed to sudden expenses. Data from the Money and Pensions Service, MAPS, in 2025 shows that over 45% of Britons have less than £500 in savings, barely enough to cover a minor emergency. Rising rents, energy bills, and food prices have made it nearly impossible for many to set money aside, pushing people to rely on credit cards or loans when an unexpected cost appears. This pattern traps families in a reactive cycle, where every crisis becomes a new debt rather than a solved problem. The psychological impact is just as severe as the financial one. Without a cushion, even small events, a broken boiler, medical bill, or car repair can create panic and long-term financial setbacks. Economists describe this as financial fragility,
a condition where households operate one missed paycheck away from collapse. Despite an increase in awareness campaigns, the savings culture in Britain remains weak compared to other European countries. Experts warned that relying solely on job stability or government benefits is no longer a safe strategy in an economy facing inflation and unpredictable costs. Rebuilding security starts with small, steady actions. Automate savings by transferring a fixed percentage of income the moment it arrives, even if it's only £10 or £20 a week. Use high-interest digital savings accounts or apps that round up purchases and store the difference. Treat this buffer as untouchable, reserved only for genuine emergencies. Over time, consistent saving, no matter how small, creates confidence, resilience, and independence from high-interest credit traps. Financial peace begins not with abundance, but with discipline and protection.
Number 6. Inflation-driven essentials and bills squeeze. Everyday life in the UK has felt markedly tougher lately, thanks to the silent creep of rising bills and the cost of essentials. Research from the Office for National Statistics, ONS, finds that in the year to June 2025, household costs rose by 3.9%, a sharp uptick from 2.7% in the previous quarter. The Independent. A striking 89% of UK households reported higher food bills by February 2025, and 79% said their gas or electricity costs went up. Find IFAs and financial advisors. These changes may seem small month to month, but they chip away at budgets steadily and invisibly, squeezing households tighter. What makes this trap particularly dangerous is its gradual but pervasive nature. It's not just headline inflation that matters. It's the fact that essentials like food, fuel, utilities, and transport are rising faster than many incomes, forcing hard choices. For those with lower incomes or heavy reliance on rent and bills, the burden is heavier. Renters experienced inflation of 4.5%, higher than homeowners. The Independent. +1. These increases don't grab headlines, but they reduce free money, what remains after covering the basics, turning a modest wage into a tight squeeze. To counter this trap, households should treat bills and essential costs with the same focus as debt repayment, not just the nice-to-haves. Start by tracking month-to-month variations in utility bills, food spending, and transport, and identify where the most significant increases are coming from. Negotiate tariffs, especially for energy, switch to cheaper food brands, consolidate utility contracts, and build cost increase buffers into the monthly budget. When the fundamentals of living become variable, planning for those changes becomes your shield. Recognizing that the expense of essentials is not static but rising allows you to act before it outpaces your income.
Number 7. Job insecurity, underemployment, and gig economy income volatility. The modern UK labour market is shifting rapidly, leaving millions in a constant state of financial uncertainty. According to the Resolution Foundation's 2025 report, nearly 1 in 5 working adults are part of the gig economy or on zero-hour contracts, with income fluctuating weekly. This instability prevents consistent saving, credit approval, or long-term planning. What appears as flexibility often hides fragility. Many workers earn less than the minimum wage once unpaid hours, travel time, and lack of benefits are considered. The illusion of control turns into a cycle of exhaustion and dependency on digital platforms. The hidden danger here lies in the psychological comfort of having work while lacking real financial growth. Traditional full-time roles that once offered pensions, healthcare, and steady progression are being replaced by temporary contracts, freelance gigs, and short projects. Even white-collar professionals now face layoffs and restructuring under automation and AI integration. For the average worker, this means unstable cash flow, limited access to credit, and increased risk of falling into debt between pay gaps. The absence of consistent income can be just as damaging as unemployment itself. Escaping this trap begins with income diversification and skill mobility.
Building multiple small income streams, part-time freelancing, online consulting, or reselling cushions against sudden job loss. Developing high-demand digital or trade skills adds adaptability when markets shift. Keeping 3 months of essential expenses as a buffer and tracking variable income through apps like Plum or MoneyHub can stabilize budgeting. Job security today isn't about one employer, it's about designing resilience that keeps you afloat when the system doesn't. Financial safety in 2025 belongs to those who prepare for volatility, not those who hope it won't come.
Number 8. Over-leveraging mortgages in a high-rate environment. The UK housing dream has turned into a financial pressure trap for thousands of homeowners. After years of cheap borrowing, the Bank of England's interest rate hikes since 2023 have pushed average mortgage rates above 6% for new deals in 2025. According to UK Finance, more than 1.5 million homeowners are seeing their fixed-rate terms expire this year, forcing them onto higher repayments, some doubling overnight. For middle-income families, mortgage costs now consume a record 43% of disposable income, the highest ratio since the early 1990s. What was once a secure investment has become a monthly strain, leaving many house-rich but cash-poor. This trap tightens because homeowners often over-leverage, borrowing to the limit of affordability during low-rate periods. When interest rates rise, repayment shock hits hard, eroding savings and pushing families towards short-term credit just to cover bills. The property market has cooled, leaving little room to refinance or sell without losses. With stagnant wages and rising living costs, even slight interest increases can trigger arrears or repossessions. The illusion of homeownership stability hides the fragility of debt tied to variable market conditions. To avoid being crushed by rising mortgage costs, homeowners must shift from passive to proactive management. Reassess loan terms before renewal dates, explore partial repayments to reduce principal, and consult independent advisors, not banks, for unbiased refinancing options. Prioritize building a buffer of at least 3 months' payments in a high-interest savings account. Avoid emotional upgrades or extensions that inflate debt. True home security doesn't come from owning property, it comes from owning it sustainably, without sacrificing long-term financial health for short-term comfort.
Number 9. Hidden fees, subscriptions, and lifestyle creep. The silent drain on UK finances isn't always large purchases, it's the small recurring payments that slip by unnoticed. From streaming services and meal kits to premium delivery plans and digital apps, the average Briton now holds 11 active subscriptions, according to Barclaycard's 2025 spending review. Many forget to cancel free trials or overlapping memberships, resulting in hundreds of pounds lost annually. Add hidden bank fees, late payment charges, or overdraft interest, and these micro-costs quietly erode financial stability. What feels like convenience is often a stealth tax on modern living, death by 1,000 tiny debits. Lifestyle creep worsens this trap. As incomes rise, or even just appear to, people subconsciously upgrade habits, better coffee, newer gadgets, more takeaways, and endless small treats. Individually harmless, these expenses collectively block long-term goals like saving or debt clearance. The UK's digital economy encourages this pattern, with instant checkouts and auto-renewals that separate emotion from money. Financial analysts call this the subscription spiral, a condition where people underestimate their actual spending by up to 35% each month because the payments feel invisible. Over time, it normalizes financial leakage disguised as comfort. Escaping this trap requires conscious minimalism. Conduct a monthly audit of all active subscriptions using apps such as Snoop or Emma to identify duplicates and forgotten charges. Cancel everything that doesn't deliver measurable value. Set a spending threshold for wants and automate transfers towards savings before discretionary expenses. Finally, adopt a 24-hour delay rule on non-essential purchases to prevent emotional spending. Mastery over micro costs builds the foundation for macro wealth, because small leaks, if ignored, can sink even the strongest financial ship.
Number 10.
Ignoring financial advice and support mechanisms. One of the most underestimated money traps in the UK is financial isolation, the tendency to avoid professional advice until it's too late. Surveys by the Money and Pensions Service MAPS in 2025 for media tips or friends' opinions, which often spread misinformation. This reluctance stems from fear, shame, or the false belief that professional guidance is only for the wealthy. Yet ignoring available support often leads to poor decisions, like consolidating loans incorrectly, missing government aid, or investing in unverified schemes. The UK offers extensive help. Step Change, Citizens Advice, and Money Helper provide free, confidential financial guidance, but millions don't use these resources. When people fall behind on payments, they often wait months before seeking help, allowing debt interest and penalties to snowball. The longer the delay, the harder recovery becomes. Psychologists note that financial denial is one of the most common stress responses, but it quietly deepens poverty. By the time most individuals reach out, they've already lost savings, credit scores, or assets they could have protected earlier. The smartest move is proactive engagement. Schedule an annual check-in with a regulated financial advisor or local support service. Learn basic literacy, understanding tax codes, pension options, and interest structures to make informed choices. Leverage free online tools that simulate repayment plans or forecast savings growth. Remember, seeking advice is not weakness, but strategy. In 2025's volatile economy, awareness and early action are your strongest shields. Financial empowerment begins the moment you stop avoiding help and start using the systems built to protect you.
The UK's financial landscape in 2025 paints a sobering picture, a nation stretched thin by invisible traps. From household debt and rent inflation to hidden subscriptions and unstable work, every corner of modern living demands vigilance. These 10 money traps aren't random, they're engineered by systems that reward spending and penalize awareness. Yet awareness is exactly where freedom begins. Recognizing these patterns gives you the power to act, to reclaim control over choices that once felt inevitable. The goal isn't perfection, it's progress, making daily decisions that build resilience rather than dependency. Take a moment today to examine your own habits. Are you budgeting intentionally or surviving from one bill to the next? Are small conveniences draining your future stability? Start small. Review your subscriptions, track your weekly spending, or speak to a trusted advisor. Financial health grows the same way as physical health, through consistent, disciplined practice. When you treat money with respect and structure, it starts working for you instead of against you. Every smart choice compounds, just as every ignored trap deepens the loss. If this video helped you see the UK's economic reality more clearly, tap the like button, share it with someone who needs a wake-up call, and subscribe for more practical breakdowns on wealth, savings, and personal finance. Comment below which money trap surprised you most or which one you're escaping this year. Knowledge alone doesn't change your finances, action does. Start today before another hidden cost starts tomorrow.